Hello everyone, Tom Simmons here. We're going to be talking today about retirement planning, and keep in mind I am not your personal financial advisor, and I'm not going to suggest that there's a particular route you should go. But what we're going to do instead is use this video, this time that we have together, to talk about definitions, to talk about the words, the names, the concepts, because as you consider your own retirement, you will hear these concepts, and no doubt you've heard about them. And it's very important to understand exactly what they mean and what they are. And it doesn't matter to me whether you are a 55 or 60-year-old student who is looking at retirement around the corner, or whether you have just turned 18 and retirement is the furthest thing from your mind. What we're about to talk about today is important for every single one of you. And the terms are important for every single one of you. And understanding how it's going to impact the quality of your life in the future is important to every one of you. So, let's start with the concept that there really are three major groupings of retirement mechanisms that people think of when they think of retirement planning. The first is their Social Security, which we'll talk a little bit about. And the second is some type of personal retirement plan. And those plans are usually divided into one of two types: defined contribution plans and defined benefit plans. And for some of you, you may have already begun to glaze over. But those are important terms to understand, because all retirement plans that you choose are going to fall into one of those two categories. And we'll go into each one of those in detail. But if you should ever forget which is which, a defined benefit plan means we know what your benefit will be when you retire. A defined contribution plan means we don't know what you'll get when you retire. We only know what you will be contributing to the plan in the meantime. So defined contribution, you're giving a certain amount, and that's all we know. A defined benefit plan means we know how much you'll get in the future, what your benefit will be. And frankly, even though we think of Social Security as a different concept altogether, Social Security really is a type of defined benefit plan. So let's take some time and go through these terms and go through these concepts one by one to help you understand exactly what your plan has in store for you and what you might want to do in the future to make changes. I'm going to start with the concept of defined contribution plans. Now, as I've said, a defined contribution plan means we know how much you're contributing as you work. We know how much you're giving in the meantime. We don't know what you're going to get back in return. And that's because in a defined contribution plan, your plan is your, underline the word your, plan. Money is put aside not in a great big fund for a whole group of people. Money is put aside for you. And the amount of money that you will get back at retirement is a function of how much you have contributed over your life to this plan, plus how much that plan has returned on investments. So, many of the different types of retirement plans that you've probably heard of, an IRA, a Roth plan, a 401k, a Keogh plan, all of these are defined contribution plans. And we'll talk about what makes each of those different from the other. The important thing to understand about a defined contribution plan is that this plan, as I've said, is yours. And how well it performs is in part a function of how well you stay on top of it. How much you end up deciding what stocks or bonds or mutual funds you choose to invest in. You have some control over what actually happens within this plan. Now, there are major tax advantages for defined contribution plans. In almost every single one of them, the donations you make towards your retirement are called pre-tax dollars. In other words, if you make $50,000 a year and you put $5,000 of that aside into your plan, you are taxed as if you made $45,000 a year, not $50,000. In other words, the contributions to your retirement plan come out before tax is applied to your salary. That is a very, very big advantage for many of these different types of plans. And what does happen is that you will be taxed on this eventually, but you'll be taxed on it down the road, in the future. You'll be taxed on it when you actually retire and start making withdrawals from this plan. For many people, this is advantageous because many people will be pulling in less money. They'll have a lower income when they retire than in the middle of their working years. And since you'll be taxed then when you have retired, your tax will be lower than if you're taxed while you're working, when your income is likely to be higher, and you may even be in a higher income tax bracket. So with this defined contribution plan, you have a plan that is held aside for you. It's not for a whole group, it's just for you. And what you get in the end will be based on the return on the contributions from the investments in the plan. You and your neighbor may have the same salary right now. You might put aside the same amount of money, and you will have very different returns because your neighbor may not have invested wisely, whereas you have. So, in looking at these, there's a variety of plans that come under this general category. The traditional IRA, the 401k plan, a 403b plan, a 457 plan, and then we'll also talk about a creature that's a little different than what I've just mentioned, and that would be a Roth IRA. So let's start with the traditional IRA. An IRA stands for an individualized retirement or an individual retirement account. So it really is exactly what it sounds like. In an IRA, you are making contributions pre-tax. You won't be taxed on them until after you start collecting. Now, when do you start collecting? Well, that choice is yours. You cannot retire before the age of 59 and a half. If you take withdrawals from this fund before you're 59 and a half, there are some serious tax consequences. In fact, there's a penalty of about 10% of what you withdraw. So you can't retire, or you can't take money out of this fund until you're 59 and a half. On the other hand, you must begin taking withdrawals when you reach the age of 70 and a half. So basically you have about an 11-year window within which you may choose to retire and start taking contributions from this plan. That's a traditional IRA. Now there are some variations on that plan. Some of you may have heard about a 401k plan. The easiest way to think about this is that it is exactly the same as an IRA with one exception. In an IRA, you set it up yourself. You open up an account using E-Trade or Scottrade or Ameritrade online. You make contributions yourself. It is completely self-run. With a 401k plan, your employer does it for you. Outside of that, there is really no difference. You're still looking at having to retire by 70 and a half and not being able to retire until you reach 59 and a half. Many of the rules are exactly the same. The account is yours, and what you receive in the end will be a function of how much you've put in and how much your account has grown through investment and through the growth of investments over time. Is it possible your investments may not grow? Yes, it is. And in fact, if you try and do this right at the end of your work life, let's say, and you're trying to do this all at once, and then there's a downturn in the economy and stocks are devalued, yes, you actually can end up with less than you put in originally. That is possible. But that is also why I am talking to you if you're 18 or 19 or 22 or 23 or 30 years old. Because planning for your retirement is not something that you should wait until you're 50 or 55 or 60 to do. It's something you should be thinking about now. Because even if there are temporary or momentary downturns in the economy or downturns in the value in your stocks, over time, you come out ahead. So now is the time to begin thinking about this. Another plan, similar to a 401k, would be a 403b plan. Just another fancy name for the same thing as a 401k or an IRA. One small difference. An IRA, you set up. A 401k, your employer sets up, assuming your employer is a for-profit company. A 403b, your employer who happens to be a non-profit organization, such as a school or some other non-profit charity, they set up. Outside of that, it's pretty much exactly the same thing. And similar to that is what we call a 457 plan. Same thing, except it's set up by a government agency if you're a government employee. So while you may hear these different terms bandied about, there is not much difference between them. Traditional IRA, your plan, you set it up. 401k, your plan, your employer sets it up. 403b, your plan, your nonprofit employer sets it up. 457, your plan, your government employer sets it up. With one little exception on that last one, and that's a 457 plan. While you have to retire by 70 and a half, there's no minimum age. In other words, you can retire before you're 59 and a half if the rules of your government agency permit you to. For instance, in the Massachusetts higher education system, if you've got 10 years in the system, you can retire at age 55. So there's no lower age limit in the plan except the one the employer sets up for you. But all of those plans are exactly the same. It's your plan. We don't know what you're going to get in the end. It's a function of what you've put in and how much your money has grown. Now, there's another defined contribution plan that is a little different, and we need to talk about it separately because the tax treatment is different. And that's a Roth IRA plan. In a Roth IRA plan, you, again, are putting money aside for yourself, and what you get when you retire depends on how well your investments did. The difference is in the tax treatments, and it's a serious difference, so you need to know the difference if you're deciding between a Roth IRA and a traditional IRA. In the traditional IRAs we have been speaking about, you don't get taxed on the money you put towards your retirement, at least not until you stop withdrawing at retirement age. And we do that because we assume your taxable income will be less when you're older. But what happens if somehow you have reason to believe that you will be in a higher tax bracket when you retire? In that case, you'd rather pay the tax now than wait until you retire and pay an even higher tax. That's what a Roth IRA is set up to do. With a Roth IRA, you're paying all your taxes now. So in the example I gave you before, where your income is $50,000, and you choose to put $5,000 aside for retirement, normally you'd only be taxed that year on $45,000. With a Roth IRA, you would be taxed for the full $50,000 of your income that year. In other words, it is not a pre-tax contribution to your retirement. It is a post-tax or after-tax contribution. However, when you start withdrawing your money when you do retire, you are not taxed on it at that point. So, it's important to figure out, will you be in a higher or lower tax bracket when you retire? Do you expect to have your highest income during your working years or during your retirement years? If your higher income is during your retirement years, then you want to go for a Roth IRA to pay taxes now and avoid the higher tax rate later. If you believe that your working years are your highest income years and it'll be downhill after that, then you go for a traditional IRA, because you'll be taxed, but at a time when your tax bracket and your total income is much lower. That's an overview of defined contribution plans. The other type of retirement plan is a defined benefit plan, which means we know how much you're going to get. Now, that doesn't mean we can calculate that today, but what it does mean is that your benefits will be calculated on a particular formula based usually on your years of service, your highest last year's salary, or an average of the last several years' salary that you had at your place of employment, and you don't have control over your investment. In a defined benefit plan, which we used to simply call a pension, and you can think of it as a pension because that's what it is, the employer runs the show. The money is taken from your paycheck. It is deposited in a pension plan, which is not an individual plan for you. It is a group plan within which many, many people participate. When it's time for you to retire, which is usually about the age of 65, so it's going to be usually higher than in an IRA, when it's time to retire, we will calculate, or your boss will calculate, this is how much you're entitled to. And it's based on maybe you've been here 10 years, 20 years, 30 years, and your average salary for the last 3 years was $50,000. We plunk it into a formula, bingo, here's what you get. Now, sometimes these plans are called funded pension plans. And that means the money that you contribute over the years is invested so that it's making money. But remember, you're not entitled to it if you have a really good year, because it's not your personal account. It belongs to the group. Your benefit will still be calculated based on that last year's salary and the number of years you have with the company. That's a funded plan. An unfunded plan means they have not been investing the money, but rather they have been using the contributions you make today to pay those who are retired today. Money goes in one hand and it goes out the other. That actually is precisely how the U.S. Social Security system operates. And since that is the most commonly relied upon, unfunded, defined benefit plan, it makes sense to talk about this a little bit. Because most Americans in this day and age have this idea that they're simply going to rely on their Social Security benefits. When it comes to Social Security, many people get a statement from the Social Security Administration every year that looks something like this. Your Social Security statement. It makes it appear as if you have an account, like a bank account or an IRA, and they're keeping track of what's in your account. Please do not think that. Do not make that error. That is not what they're doing, and that's not what they mean. When you pay Social Security taxes today, and those taxes are equal to 7.65% of your salary, matched by your employer, that is not going into an account for you, earning interest for you. The money you contribute in this week's paycheck went in and went right out to pay benefits for those people who are already retired. And I've heard people say, well, you know, I've paid Social Security my entire life, so I have a right to something back, right? Well, technically, actually, wrong. You do not. You do not have a right to an account because you don't own an account. The money you paid today was used to fund retirees today. Your children, your grandchildren, the next generations, are the ones who will pay Social Security taxes to fund your retirement via Social Security. So in this system, current workers pay for current retirees, and that, of course, has added stress to the system, because when the system was developed, there were as many as 40 young people working to support every retiree, and our life expectancy was only about age 65. Today, with smaller family sizes, there are only 2 or 3 young working people for every retiree, and those retirees are now living beyond 80 on a regular basis. And that means there is stress in the Social Security system. So for those of you especially who are at the young end of your lifespan, don't just not worry about this. Don't just say, well, I don't have to worry about retirement because there's Social Security and something will happen. You know, it'll be there. It may not. Changes will have to happen in this system in order for it to work monetarily. At the current time, when you retire, you can retire on a sliding scale, but it was between 62 and 70. Now I believe it's between 65 and 70, or 72. Your benefits are calculated based on the amount you've contributed to the system and an actuarial table of how long you're expected to live based on what age you're retiring at. It's not because you have an account there, but it is a defined benefit plan. So, in my case, and this is just to give you an idea as to why you should think about alternatives to simply relying on Social Security. Looking back at my statement, and I'm going to go back many years just in order to make a point here. Back in 1989, I had an income of $30,000. Now, when I go through this earnings record that Social Security keeps on me, and I look at what will happen should I retire at age 66 and 10 months, which is what they consider the point of full, retirement benefits. According to their calculations, my defined benefit would be a grand total of $891 a month. Now, I know that's not something that I'm going to be able to live on very easily when I retire. I need to have another retirement plan. And in fact, and again, for those of you who are younger and saying, why do I need to worry about this? If we go back to that year of 1989 or 1990, when I had an income of $30,000, with that 1 year alone, if I had started then and put 10% of my income in an IRA that didn't do very well, let's say I put 10% of my income, 35, and kept it there for 35 years and did this every year for 35 years and only made 5% interest, which is not very much. By the time I was 65, I would have $301,000 ready for my retirement. Now to compare that to Social Security. Social Security says I'm entitled to $819 a month. If I had taken 10% of my income and put it aside and only made 5%, and quite frankly, over the long term, the stock market always returns a much higher return than that. Much higher return than that. But if I say just 5%, and brought in $301,000, if I divide the $301,000 I'd have by the $891 per month they would give me, that would last me until I was into my 90s. Which means, if I had put 10% of my income aside and let it grow only for 35 years until I was ready to retire, and if I had a really decent rate of return, and it's not really unexpected to think of a 7, 8, 10, 12% return over time from year to year, I'd be doing a lot better than relying on Social Security. So, if you're young, I want you to think really hard about how much money you could put aside to invest in your own quality of life and your own well-being. Because over the course of 30 or 35 years, you can really collect yourself a nice nest egg through the magic of compounding. Please don't rely just on Social Security to be able to fund your retirement. If you're like most Americans, you will live many years beyond your retirement, a full generation or maybe even 2. You will want to have a high quality of life. You will engage in recreation. You will have higher medical expenses. Where is that money going to come from? One of the best ways to secure yourself a high quality of life in retirement is to think about this now when you're young. For those of us who are closer to retirement, myself included, it doesn't mean we've blown it, because government regulations allow us to catch up on years that we missed by not making contributions. We can catch up through individual retirement plans. We can catch up through Roth plans. We can catch up through additional contributions in our employer's 401k plans. Taking a look at what we can put aside and what that will add to our retirement security is not something to worry about when we're 60 years old or 62 years old and feeling the changes of weather in our joints and bones and saying, gee, I should start thinking about my retirement income. The time is now. Think on that, and in our lesson, I will on Moodle, I will give you some calculators to play with to see what you can do to help yourself. Thank you.